A meltdown on Wall Street today, with the Dow taking yet another major plunge right before the closing bell. It's about to end the day down more than 900 points.
The S&P just handed in its worst day since June 11th.
With COVID cases shooting up across the country, the markets nosedived today. Here's a live look at the Dow, which is just about closing down 649 points there, basically erasing its gains for the month of October.
Yeah, what a day. Rising COVID cases, no doubt. Election uncertainty, no new stimulus, all proving to be a toxic formula for the markets as investors cash in, and the VIX fear gauge hitting its highest level since mid-July. As you just...
Alright, today is Sunday, November 1st, and this is a market review for the week that was and an outlook for the week to come. And here we go, the Dow Industrial Average closing in the red by 157.51 points, or a decline of 0.59%. The Nasdaq down 274 points even, or a decline of 2.45%. The S&P 500 also in the red, down 40.15 points, or a decline of 1.21%. Here is the sector's performance for Friday. Energy leading the pack and gaining the gold, the silver, and the bronze, because it is the only sector that managed to close in the green decisively. The rest of the sectors of the market lagged, and the leaders of the laggards were consumer cyclicals, technology, and utilities. Let's contrast that with the performances for the week. All in the red decisively. We've witnessed severe losses throughout the week for the entire market. No sector spared here. Leading the decliners, technology, industrials, and financials. Moving on to the futures market performance on Friday, we see a continuation of the pain in crude oil, and when we move on to softs, we see gains in lumber. You might have heard the news that stores across many downtown cities in America boarding up their windows in expectations of post-elections violence, leading lumber prices to soar again. And we do see gains here for OJ, yet we see declines of 1% or so in cotton and coca. What about metals? Gold remains muted, silver rallying by about 1.5%, platinum, copper, palladium also muted. And we see feeder cattle continues to gain here in meats. It's been a few impressive days of massive gains for feeder cattle this week. And what's going on in grains? We see a rebound in soybean oil, yet the rest of the futures in grain remain muted. And moving on to the big casino, the options market. And right away, we see Apple. Apple was down significantly on Friday. Yet we see significant bullish activities here, which is a typical behavior from options traders. Apple leading the way with 2.7 million contracts traded on Friday. About 62.5% of those were calls. NIO at number 2 with about 684,000 contracts traded on Friday. About 71% of those were calls. And at number 3, Tesla, 654,000 contracts, and look at that, 41% of those were calls. We see a majority bearish bets against Tesla, and I'll explain to you why I continue to be bearish on Tesla and continue to hold my bearish bets against the name during the charts or the technical analysis. Did we have some interesting trades on Friday? Yes, we did, starting with Pinterest, and we see here they're buying the 62 calls expiring in November, the monthly expiration. And what they're doing here with Pinterest is the same pump they did with Snapchat. Right after earnings, you see a squeeze, a short covering squeeze. What happens is the implied volatility surge massively for out of the money calls. And traders see the opportunity here of buying way out of the money calls. And as soon as the stock continues to move higher, these options will appreciate tremendously from the time value alone. And then we see the 31 puts in Uber expiring this upcoming week. This is a bet, of course, for the results of Proposition 22, which we will know during Election Day here in California. I do have the 35 puts. I've been talking about it for a while. I intend to close that put before the elections take place, regardless of the outcome, because again, the implied volatility is surging higher and higher, and I'm already making significant profit on the trade. The outcome of Proposition 22 will have significant implications on Uber shares. And we also see at the bottom of the table there, Costco. They are buying the 395 calls expiring November, the monthly expiration on November 20th. And this is an interesting trade. We see the rise and the surge of COVID-19 cases across the country, and we have witnessed during the first wave of the virus how grocery stores and big box stores such as Walmart and Costco benefited from the surge of stockpiling. We do know that there is another surge of stockpiling happening right now, and perhaps all the rout in the market and the uncertainty will shine a spotlight on Costco as a safety trade where traders can park some cash and make bullish bets on the name. Moving on to the headlines that shaped the day. And right away on Friday in the morning, we had the data from personal income. And the data shows that income increased significantly for Americans during the month of September. Here is my problem with this kind of lump sum data. If you pile a bunch of regular folks all together, and then you throw Jeff Bezos in the mix, and you measure the increase or the decrease in their income in a given month, you will see that their income increased significantly. Now, take Jeff Bezos out of the equation, and the picture would be much different. To illustrate this point, here are some data we got from the housing market, and we know that the housing market been surging the last few months due to two factors. Number one, the haves. The haves are parking some of their investments and their gains in buying properties. And the second factor is due to the stampede from the morons who are seduced easily by the low mortgage rates, and the stampede caused the housing market to soar and for home prices to rise significantly. And when that happened, it was a domino effect of the fear of missing out. People stampeding to buy homes, locking in the low mortgage rates before home prices increase further. But there is another side to the story here, and here it is. We have 8 million people who are behind on their rent payments. Furthermore, we have an additional 6 million people saying that they are doubtful they could make the November rent payment. Now, tell me, how did the personal income for Americans rise significantly in September, while we do have, from this piece of data alone, 12 million Americans struggling to pay the rent? And speaking of the struggles of the average American, let's talk about Federal Reserve Chairman Jerome Powell. The media been having orgasms left and right, gloating over Jerome Powell's quote-unquote success. And here is a piece from Barron's calling Jerome the winner. And in the article they say that it doesn't matter if the Republicans or the Democrats win the White House and Congress, because at the end of the day, the leader of the financial policy in the U.S. remains Jerome Powell regardless. Therefore, he is the winner. And they continue to talk about how Jerome's decisions saved the economy and prevented the market from crashing, etc., etc., as if that is a good thing. And they're making it sound as a good thing for the average reader who's not informed on the reality of the situation. And here is another piece you might have seen. It gained a lot of popularity on social media due to the cover shot where they're trying to make Jerome into a glamour kind of personality. It looks like the cover of Vogue magazine, but it was actually New York magazine that did the piece, and they called Jerome Powell the world's best bureaucrat. They credited him for saving the market and for the rally that we have seen so far. They go as far as calling Jerome our hero. Now, here is what Jerome actually did. He decided to open the floodgates and the tsunami of liquidity in his own terms, flooding the market with cash that was printed out of thin air and therefore rescuing the stock market, because the Fed has the ability to lend money to corporations at zero interest rates. And they did lend to companies on the verge of bankruptcy, creating what is known as zombie companies. But the Fed did not stop at that point, and it went further by buying bonds, billions of dollars worth of bonds from behemoth companies such as Apple. Apple does not need any help from the Fed. They have an enormous amount of cash, yet they also benefited from the Fed's juicing operation. And we say juicing because that was the intent and the purpose behind opening the liquidity floodgates operation. It wasn't just meant to save the stock market. It was meant to create an asset bubble in the market, because the Fed was aware of that consequence, yet they thought that it was worth it. And what's going to happen now is that bubble will burst and it will create further economic pressure on the system. All of what that did is help the rich only, because the majority of ownership in the stock market goes to the 1%. They own 99% of the stock market. 1% of the population owns 99% of the market. And as the asset bubble continues to inflate, the rich becomes richer, and we see no problems whatsoever in the stock market. It goes up every day. Meanwhile, in the real economy, in Main Street America, we see people lining up in food banks, unable to pay the rent. We see small businesses being destroyed and unemployment continue to surge. So how is that our hero? What part of our hero is racking up trillions of dollars of debt for the next generation to deal with? What part of our hero is opening the floodgates of money supply to destroy the US currency? What part of our hero is making the stock market a liquidity addict, just like a heroin addict that cannot function without further supply of the drug and will suffer a withdrawal without it? What part of our hero is creating the biggest and widest wealth inequality gap in history? What part of our hero is opening the floodgates for public companies, but not small businesses, and without an exit strategy in mind? Indeed, he is our hero, if by our you mean the rich. And I assume that is the audience for Barron's and New York Magazine. Because this is what our hero did since the crash of the pandemic, the biggest and the worst economic crisis in our lifetime. We have seen a sudden reversal of fortunes for the rich that was quickly corrected by the Federal Reserve's action led by Jerome Powell, leading to a massive asset bubble in which the rich became even richer than before, thus making the pandemic the best thing that ever happened to the 1% in this country. Where is the hero that would reverse the misfortune and the suffering of the poor and the middle class? And here is another headline where you see the environment that the Federal Reserve and our hero, quote-unquote, created. Wealthy New Yorkers who fled the city to the suburbs to isolate themselves from the crisis economically and health-wise. They are now not ready to return altogether back to their hometown in Manhattan, back to their multi-million dollars condos. But don't feel bad for them, these poor people, because they are still commuting back and forth to the city via helicopters. Can you imagine the pain, the suffering, and the trauma they have to go through every time they take a chopper back and forth from their multi-million dollars homes? But wait, there is more. Our hero, who opened the floodgates with trillions of dollars lent to large public companies, has only spent a fraction of the funds the Federal Reserve dedicated for their quote-unquote Main Street program. And on Friday, we heard from the Fed that they finally lowered the minimum amount of loans from $250,000 to $100,000 because certain small businesses could not afford to rack in $250,000 minimum in debt. And it just goes to show the mentality of how the Federal Reserve thinks that small businesses somehow able to afford a minimum of $250,000. Like, oh my God, these small businesses are so poor. They cannot even afford $250,000. What's going on here? But this is the disparity of two worlds and two Americas. And the Federal Reserve is just discovering that there is a world outside of the rich elite bubble in which $250,000 is considered excessive and unattainable. Shameful and disgusting fabrications of the fact from New York Magazine and Barron's glorifying Jerome Powell, the destructor of the American dream, as quote-unquote our hero. Moving on to some company-specific news, and we have Netflix raising their prices from $13.99 a month to $17.99 a month for the premium subscription. And this is very important to read. Number one, Netflix strategy been very flawed. All they did, and again, that goes back all the way to the Federal Reserve again, when you can raise debt interest-free, then why not go on a spending spree and who cares? And this is what Netflix did, borrowing billions of dollars of interest-free debt, hiring the biggest superstars in the world to create content for them. Very expensive content, $100 million a piece, $300 million a piece, all to gain the name recognition and attract new subscribers. That strategy worked for a while, but it is not working anymore because pretty much everybody knows that Netflix exists. And what the company should do instead of spending money, obscene amount of money, to create content from quote-unquote superstars like The Rock and Kevin Hart, Will Smith, etc. Overpaying these stars for content that would be consumed in less than 2 hours, and then the viewer will crave more and more content to binge on with no success because Netflix already spent the money in creating the very expensive content that only lasted for 2 hours. So what they need to do is create more content with the money rather than more expensive content. Instead of creating one movie costing $200 million, how about creating 20 movies that cost $10 million each instead? And then I wouldn't mind raising prices for Netflix. But the other point for this story is, for all the morons and geniuses who keep saying that technology is the future and keep investing in the FANG names because there won't be any future without them. Here is the problem. The valuations are already counting the future and beyond, number one. Number two, you see a company like Netflix reaching a ceiling in the number of subscribers they can attain. So now they move into plan B or part 2 of their strategy of price gouging, raising prices. The first phase of the strategy was to spend to attain and attract maximum number of subscribers. After that, and after destroying all the competition due to the interest-free debt that Netflix can raise, which other movie studios and producers can't because they're not publicly traded companies, thus giving Netflix the advantage of creating somewhat of a monopoly. The phase 2 of the plan now is to raise prices, so expect more and more price hikes for Netflix, which is the same dilemma that Apple is going through. Their growth is stagnant, so all what they have to do is milk their existing customers for more cash by offering more services and products for them. And the question here, what are the growth prospects for a company that is maturing? Meaning that all the people who say you gotta buy Netflix because Netflix is the future, no it's not. They're already maturing and moving to tactics of stagnant companies, meaning that their valuations are already fully priced or that they will never grow into full valuation, paving the way for stock declines and stagnation for these big tech companies. Moving on to Dunkin' Donuts. Remember all the activities we saw in the options market regarding Dunkin' Donuts? Now we know that the company will be acquired for about $11.3 billion by Inspire Brands, the same company that operates Sonic Restaurants and Baskin Robbins. So there you go. No more Dunkin' for you, at least in the stock market. And moving to Apple, the Federal Reserve company you know that their earnings were pretty much a disaster. Their income did not grow year over year. It actually declined. So why the hell this company is trading at all times highs, or at least were? But the pain continues for the name, and we see that Apple now acknowledging that they have problems with their AirPod Pro headphones, and they will have to replace them cost-free. Don't worry about cost, because Apple, as you can see from this headline, has about $191 billion in cash that they're stashing in Ireland to avoid paying taxes in America. Their cash positioning is down about 7% year over year, but it goes to illustrate that a company that does not produce growth in revenue or income continues to hoard a massive amount of cash due to tax avoidance, and now we do have the Federal Reserve pumping Apple with cash, a company that does not need any more cash, yet the Fed continues to buy Apple bonds, and Apple used the proceeds to buy back their stocks and artificially hyperinflate the stock. Until, of course, the zombie investors in the name wake up to the fact that the company is not growing, will not grow, and that the valuation right now is artificial and inflated, and it is time to say goodbye to the stock, as we witnessed from the reaction right after Apple reported earnings. Moving on to the last bit of news from Walmart. And Walmart decided to temporarily pull out all guns and ammunitions from their shelves in anticipation to civil unrest and post-election violence. It is a no-brainer that you have to buy some gun manufacturers' stocks before the elections, because they will rise on post-election civil war optimism. Moving on to review some of the earnings we had on Friday, starting with Exxon Mobil. And right away, the most important thing we're looking for here is the earnings number, aka the bottom line. We want to know if these oil giants are managing their costs efficiently amidst an environment of continuing revenue declines. And you see from the results of Exxon Mobil, they managed to improve their numbers quarter over quarter, slightly turning the corner. In the upstream business, last quarter, they had a negative earnings of 1.9. This time around, for the third quarter, they managed to reduce that to only 0.4. And what about the downstream business? Again, an improvement. Last quarter, it was a loss of 0.6. And this time around, the losses were reduced to only 0.2. Now, keep in mind that they were only capable of reaching these numbers after massive austerity measures such as layoffs and cost cutting significantly. This is the result, just to save the dividends. And Exxon executives indicated in the call that they are capable of keeping the dividend for the foreseeable future. However, if the crisis continues all the way beyond the first half of 2021, then in most likelihood, Exxon will have to cut the dividend. Moving on to Chevron, and let's see how these results compare to Exxon. Right away, what we're looking for here is earnings, the bottom line. And as you can see, their upstream business and downstream business remain profitable. Yes, they're down significantly year over year, but unlike Exxon, they are profitable when you isolate those two segments alone. Now, when you combine other costs, Chevron has negative earnings. However, they're also better than last quarter. So we see both companies turning the corner just slightly. However, turning the corner did not happen due to massive revenue increases, rather to maximum cost cutting methods. And right away on Friday, you saw the contrast between the stock reaction for both companies. Chevron managed to outperform Exxon. The dividend for Chevron is about half what it is for Exxon, but it is a lot safer in the foreseeable future. Moving on to the heat map analysis, starting with the daily heat map for Friday. Right away, you see pain across the technology sector in the aftermath of big tech's earnings. Apple down, Facebook down, Amazon down, Netflix down, Microsoft down, but look at that, Google, the only shining light in big tech, up about 3.8%. We also saw significant weakness in the software names, specifically Shopify after the earnings, down over 10%. Adobe down significantly, so did Square, Nvidia, and other high-flying names in the sector. And when we look at communication services, we talked about Google, Facebook, and Netflix, but you also see the video game stocks such as Activision, Electronic Arts, Take-Two all down severely on Friday, on the heels of Activision's earnings, which were very good in my perspective. However, the guidance for next quarter was much weaker than expected. What do we see in consumer cyclicals? Pain across the board with very marginal gains in some of the travel names and hotels. We saw on Friday an announcement from the CDC that they will allow cruise ships to sail again under new guidelines earlier than expected. And right away you saw a huge pop in cruises, hotels, casinos, airlines, and you see that reflected in summer performances in consumer cyclicals. What about consumer defensives? Nothing notable here. Declines across the board. Pain in the beer sector. Costco down. However, we see Colgate. Are you brushing your teeth? Because you should. Colgate managed to outperform after their own earnings, up about 2.9%. Financials, when we look at the credit card services such as Visa, MasterCard, even the fintech names such as PayPal, down significantly. And by the way, MasterCard lost 6 months worth of stock gains in just 1 week. All it took 1 week to erase 6 months worth of gains. So if you haven't learned when to take your profits, perhaps you should take a lesson from what happened to MasterCard stock. Yet we see green in banks and specifically regional banks. The KRE, the ETF that tracks regional banks, outperformed significantly this week, and it has been outperforming for the entirety of the month. And that is of course due to the increase in treasury yields. Remains the mystery here why treasury yields are rising rapidly while the markets are in panic and fear mode. Moving on to the healthcare sector, what do we see here? Muted action in the big pharmaceutical companies and the healthcare insurance providers. But we see significant pain in biotech and in diagnostics, specifically Illumina, down over 7%. The stock of Illumina been underperforming significantly. Oil, right away you see the contrast between Chevron and Exxon. Chevron closing in the green, Exxon closing in the red. And if you watch what we said when we reviewed the earnings a little earlier, this is not a surprise to you. What's going on with industrials? Muted day, the pain in UPS, FedEx, and all the shipping giants continue. And we recommended shorting FedEx on Monday, and that was a very profitable trade. Boeing down significantly, but we see Raytheon rebounding. Raytheon experienced significant whack earlier in the week, and on Friday had a bounce of 2% or so. Materials, we see a bounce in gold. Gold mining stocks having significant gains, yet the commodity itself remains muted. We're seeing this divergence between stocks and commodities. Crude oil continues to decline, however, energy stocks gaining the last few days. And it is the same case with gold. Utilities red across the board, real estate with only residential outperforming. But let's move on to the weekly heat map and let's see the contrast in the picture. Right away, you see it is a sea of red, declines across the board. Massive declines in the tech sector, healthcare, energy, industrials, cyclicals, very few names got spared here. Notably Google after the pop on Friday, and you see Sony right next to Apple. You see a green block, that is Sony. Sony had impressive earnings. Beside that, it is pain across the board. And let's check on the ETF performances for the week. Right away, you see that the inverse indices managed to outperform, whether it is the short triple Qs, my favorite, or the SPXS, the UVXY for the VIX, the VXX, the TZA, which is an inverse ETF for the IWM. The FOS gaining significantly. It is an inverse index for financials. However, look at the performance of the KRE, the regional banks, not down as say the XLF. We talked about that. Regional banks outperformance due to the rise in yields. And let's move on to cover the rotation trade for the week. And here is the scoreboard. And you see right away, pain across the board, whether we're talking about the stay-at-home stocks, the momentum stocks, or the reopening comeback stocks. Nothing was spared today, although the losses are more significant in the reopening trade. And of course, it is notable that Zoom and Peloton, from the momentum names, finally experiencing the pain as well, indicating that the action for the week was not an escape from the reopening names to the stay-at-home names, the safety of the stay-at-home names due to the surge of coronavirus. This week's action was a reflection of the overvaluation across the board. In addition to the fear of the upcoming elections, combine both of these factors and you will see pain across the market. And as we said for weeks now, there is nowhere to hide until we correct some of the overvaluations in the market. Moving on to cover some charts and starting with the SPY 15 minutes chart. Right away, as we started trading in the morning on Friday, the SPY managed to climb all the way to the level of 329.50. And by the way, all of these levels are pre-drawn. We picked these numbers on Monday and they are working amazingly. As you can see, in the morning, reaching the 329.50, facing resistance from that level, reversing, cutting the next support level of 326.50. There was a bit of struggle if you switch to a shorter time horizon, but we managed to cut it, and once we traded below it, it becomes resistance. And you see around 1 o'clock Eastern, the SPY attempted to recapture the support line with no success, reversing, gathering some energy, and then it gave it another shot and it managed to crack above it. But at the end of the day, it closed right on the line of 326.50. So what do we see in the big picture, the weekly chart? This is the bearish scenario that we've been maintaining for weeks now. The bearish ABC pattern, and we are starting to see the C leg formulating to the downside, which indicate that we have further declines to go here to complete the C leg. And the levels we're eyeing are between 300 and 310. Reaching anywhere near those levels will complete the C leg, and we will have to take it from there. Now keep in mind, we have to represent the bullish scenario. And for that, here it is, a weekly chart. And the bullish case says, look, we ran really hot. We're taking a break. This is a consolidation to shake out the weak hands and invite newcomers in the market and then ride higher. We've seen that happens before in 2018 in the consolidation case number 1, and again in 2019 in the consolidation case number 2. We're seeing that again. We're going to go back and forth, and then resume the rally higher. We have to keep this perspective in mind. Moving on to the Qs. Here's a 15 minutes chart, and right away we started gapping lower. Yet the Qs managed to have a bump in the morning, reaching all the way to the resistance line of 275. And again, all of these lines are pre-drawn. We picked these numbers in the beginning of the week, and they're working like charm. You see the rejection from 275 right away. That was your signal to add to your shorts or initiate new shorts. And you see the Qs reversing all the way to the support line of 271.50, catching a mini bounce from that number before reversing even lower, undercutting the support line of 271.50. And unlike the SPY, the Qs did not manage to regain and climb all the way to recapture the last support line of the chart. Now, let's move to a bigger picture, the weekly chart of the Qs. And what do we see here? Again, we see a bearish ABC pattern. We've been talking about this for weeks now. And to complete the C leg, we have to dive all the way back to the levels of 230, meaning that we will have a significant correction in the Qs if this outlook is correct. Furthermore, we see a failure in crossing in the MACD indicator. The Qs attempted to cross the blue line average to create green impressions in the histogram of the MACD, but we see a rejection and a reversal downward, indicating that the Qs are not ready to make a positive cross in the MACD, which also indicates that there is more pain for technology names in the days and perhaps weeks to come. Moving on to the Dixie, the dollar index. You would think that the dollar index will have a significant move this week when you look at the indices. However, the dollar index remained level-headed and it's just looping around the level of 94, back and forth, turning it from resistance to support, back to resistance, as if the dollar index is not ready to make an impulsive move yet until after the outcome of the elections. You see the impulsiveness of the stock market, yet commodities remain very level-headed. And by the way, here is the weekly chart for the dollar index. We talked about a bullish ABC pattern that went out of the window the moment the chart crossed below the 93 level support on a weekly basis. However, other technical analysts been saying that we're seeing a cup and handle formation in the dollar index. If that is true, then we will see further gains for the dollar index in the weeks to come. I'm not so sold on the cup and handle formation. I think if Joe Biden wins the elections on Tuesday, the dollar would reverse lower. It might initially pop hand in hand with a panic in the stock market and selling pressure. However, as the market starts to settle, we'll realize that the Biden administration will initiate even a bigger stimulus, which will add pressure on the US dollar. Let's move on to gold. From a weekly perspective, what is gold doing? Not much. As we discussed, the level of 1925 remains firm resistance. All of what gold is doing is a bearish ABC pattern with the destination of 1800 in mind to complete the C leg. Now, all of that is going to change based on the outcome of the elections. So this is what I see pre-elections. After the results of the elections, gold could behave differently in accordance with the movement in the US dollar. Now, let's move on to a daily chart of the TNX, the 10 years yield. This is the mystery all week long. If we're seeing panic in the stock market and a lot of pressure to sell, why aren't investors rushing to buy bonds, thus pushing the yields lower? Why are they selling bonds rather than buying them? Where is the cash going from selling all these stocks? We have to piece out the mystery here. And before we do that, let's review the chart's pattern. Number one, we talked about a bull flag formation, which played to the upside. And then we talked about an ABC pattern, bullish ABC pattern that also played to the upside. And when that was completed, we saw declines in the TNX and then a reversal and continuation for the impulsive move higher. How do we explain that? Number one, investors are raising cash, selling stocks, not buying bonds, actually selling bonds, holding big cash positioning on the sidelines, waiting for the outcome of the elections before making their investment decision. But from a chart's perspective, how do we read the TNX and where it's going next? I can't do it from this chart, so I have to switch to the TLT, which is the inverse of the TNX. It's not exactly an inverse. The TNX tracks the yields for the 10 years Treasury note. The TLT tracks the price of long maturity bonds, 10 years and above. So let's see if the TLT can tell us something different here. Moving on. This is a daily chart for the TLT. And what we see here is what is called a descending channel. The beauty of a descending channel that you could play it and trade it buying the TLT when it reaches the lower level of the channel and selling the moment it hits the upper level of the channel. It is a day trader or short-term trader's dream, easy to trade. But at some point, the descending channel gets broken to the upside and you see the impulsive breakout higher. We've seen that in the dollar index, by the way, and we are going to see it in the TLT. It is not a guess, not a probability, not a matter of if, but a matter of when the TLT is going to break higher. And that in return will push the TNX and the yields for Treasury notes lower. Now, moving on to the VIX, a daily chart. We talked about the bull flag breaking to the upside, defeating the resistance, now support of 30.5. And once that happened, you see the impulsive move higher. What we talked about on Thursday is recocking the gun to launch even higher. You saw that happen on Friday. However, we retreated by the end of the day, yet closing above the closing price on Thursday, meaning that the VIX remains positive, we remain bullish on the VIX, and I expect to pop all the way to the levels of 44.4 before we face any significant resistance. Now keep in mind, if on Tuesday we have the election results early on, meaning if Florida or North Carolina flip to the Biden side, we will know right away that there is a good probability Biden will be the next president, and you will see the VIX declining because a big catalyst for the pop in the VIX was elections volatility. Moving on to Apple. From a weekly chart perspective, let's see what's going on with Apple. Again, we've been talking about this formation for a while now, the ABC pattern from a bearish outlook, which will eventually lead the shares of Apple all the way below 100 to 96 to be specific. Now you have to remember that the 106 levels remain very strong support, and unless we open gapping down below 106, I think we will have hard time breaking that particular support. But once it is broken, the floodgates will open and Apple will likely not stop until it visits the 96 level. That is a significant drop from where we are right now. We're talking a decline of over 15%. But if you thought that was scary, wait till you see Tesla's chart. And for that, let's go ahead and review Tesla from a weekly perspective. Number one, we have a confirmation for 2 weeks now of a successful MACD crossing to the negative side, creating red impressions in the histogram. The last time we saw that happen in Tesla shares, the stock lost almost 50% of its value. In addition to that, we see a breakage of the very steep upward trend this week, which in my opinion and in my outlook would take Tesla shares eventually all the way down to close the gap at the level of 242. That is about 38% decline from where we are right now. So if you think you're brave enough, you should be shorting and holding your shorts in this name. I continue to hold my puts, and I will perhaps add to them even more, rolling down further. And you saw the pain that Tesla shares experienced on Friday. Why is that? It is due to margin calls. As margin calls started to hit, specifically for amateur retail traders, their brokers had to liquidate some of their core holdings. And we know the younger and newer traders hold Tesla as one of their top 3 holdings. So that had to be sold to meet the margins elsewhere. And now let's move on to preview the earnings schedule for the upcoming week. Right away to Monday, we have PayPal and Mondelez. I do own Mondelez, and I did own PayPal all the way till the end of June, but I am looking to short the name, so I'm interested to hear what they have in their earnings report. Tuesday, another important name for Emerson, Cisco, McKesson, and Wayfair. All of these names I owned at some point. I have Emerson, Cisco, and McKesson in my current portfolio. We've seen a lot of pain recently, specifically for Cisco shares, so I'll be very interested to hear their earnings report. Wayfair, just like PayPal, I owned all the way to June, and I thought it was overpriced then. I dumped it, and what do you know? The stock rallied significantly from that point on, but every melt up will be met with a meltdown, and you see shares of Wayfair suffering severe losses the last few weeks. This is Judgment Day for the name. Wednesday, we have Qualcomm and Expedia, important names for the health of the semiconductor industry, the 5G trend, and for Expedia, a reflection of the health and the quote-unquote recovery in the travel industry. Thursday, the heaviest day by far, we have Alibaba in the morning, and then after hours we have T-Mobile, Trade Desk, Ruko, Uber, big week for Uber, whether it's the elections, Proposition 22, or their earnings. But Uber is having very big week next week. Peloton, Judgment Day, for one of the most overpriced names in the stock market. General Motors been on a tear recently. We have to see if the numbers meet expectations or not. And most importantly, the outlook and the progress on their EV endeavors. Square got whacked severely this week, and it will move based on PayPal's results. If PayPal crashes on Monday, we're likely going to see Square following on the footsteps of PayPal. And then we have two video game names. We heard from Activision. They had a very impressive earnings report, but the guidance disappointed. We saw Electronic Arts and Take-Two suffering losses as a result. So perhaps we will see a buying opportunity in these names. We'll have to wait and see. No major moves here until after the elections. What about Friday? We have Berkshire Hathaway in the morning and then Marriott, an important name which happens to be in my portfolio as well. I want to see the recovery in their China operations. And the last bit of earnings we have, let's keep it sweet, and we are anticipating earnings from Hershey's. And now let's move on to conclude this video. Right away after the indiscriminate crash in February, the COVID crash, we saw panic in the stock market. That panic subsided and we saw rationale from market participants saying, why would we punish all stocks equally? Yes, the crisis is going to hit cruises and airlines and other sectors in the economy very hard, but will also create winners such as Microsoft and Zoom, Peloton, Wayfair, PayPal, Netflix, etc. And you saw in the beginning of the recovery and the rally from the March bottom a fundamental case in buying these stocks. The valuations got very attractive and there was a fundamental case to make in buying these names. So what happened? You saw the early entrance to the market buying Netflix, Microsoft, Apple, Facebook, Zoom, etc. And as the rally started to become hotter and you started to hear headlines about the gains and the recovery in the stock market, and all of a sudden neighbors started hearing about other neighbors and friends, hearing about other friends, relatives, hearing about other relatives joining and making money in the stock market. And now the rally that was built based on solid case of fundamentals becomes a frenzy of retail investors who perhaps never invested in the stock market, but now they're interested in it because of the quote-unquote gains they see others have made. And when that happens, we see the creation of the mania and the bubble and the Robin Hoodiots phenomenon of amateur investors buying names with no regards to the fundamentals whatsoever, pushing these names higher and higher. It is the 2020 gold rush. And I did participate in that rally all the way to the end of June when I sold all of my tech holdings because I saw signals of an environment just like what we saw back in the dot-com bubble in 1999. And after I stepped out of the market in June, you saw the rally getting even hotter as more and more participants participate in the stock market gold rush, creating a massive bubble. And the question always was, and the criticism from some of the viewers at that time was, why are you so bearish and so negative, setting out of the market, missing out on all of the gains? And my response was the following. The last part of the bubble before the burst is usually the hottest. And what happens when you join the rally or you stay in the market during that period, the last hurrah, is that you become a creature of the bubble and you are now blinded. Your rationale is not working anymore. You are drowning in emotional investment decisions, seeking the euphoria and the adrenaline rush of stocks climbing 3, 4, 5, 6% every day. And it becomes Nvidia this, Shopify that. And before you know it, you're buying stocks at the highest valuations. And here is the catch. Remember the Cinderella story in the fairy tale when the pumpkin and mice are turned into horses and handsome grooms for Cinderella to dance with. However, the catch was that after midnight, the magic will be over and everything will return back to being pumpkin and mice. Now, when the stock market correction starts, if you are a creature of the bubble, if you are looking at stocks like Shopify and Nvidia and Peloton at the highest valuations as horses and grooms, when they are in fact all along been pumpkin and mice due to the extension, or shall I say overextension, of their valuations. But you're not going to realize that, and you're going to look at every correction and a dip as an opportunity to buy, further burying yourself as stocks continue to slide lower and lower. The party is over, but you don't realize it yet. This is why I did not participate in the bubble. I got out in June, and I have zero regrets. And this is what we're seeing in the market right now. Apple, Facebook, Zoom, Salesforce, you name it, whatever name it is. At the end of the day, the market overall trading at these levels, very overvalued levels, is nothing but pumpkin and mice. They've been groom and horses since the recovery all the way to September. In September, midnight time arrived and the reality appears again. It always been pumpkin and mice. For some unfortunate investors and traders, they still don't get it and they still don't see it. But don't take my word for it. Listen to the greatest investor in our lifetime explain it for you.
It's like most trends. At the beginning, it's driven by fundamentals, and at some point, speculation takes over. The very fact that the fundamentals cause something that people have looked at for years without getting excited about. Fundamentals change the picture in some way. Copper does get a little short, or people get a little worried about currency and maybe gold goes up or whatever it may be. But it's that old story of what the wise man does in the beginning, the fool does in the end. And with any asset class that has a big move that's based initially on fundamentals is going to attract speculative participation at some point, and that speculative participation can become dominant as time goes by. And famous case always being tulip bulbs. I mean, tulips may have been more attractive than dandelions or something, so people paid a little more money for them. But once a price history develops that causes people to start looking at an asset that they never looked at before and to get envious of the fact that their neighbor made a lot of money without any apparent effort because he saw this early and so on, we're not good at the game of, when it gets into the speculative area, figuring out how far a speculative boom will go. If the fundamentals are attractive, we think we're getting a lot for our money, buying equities or whatever it may be. We'll make some money. We may not make as much money, remotely as much money as somebody who is plays out the last 30 days or 30 weeks of a real wild orgy. I mean, these things, they tend to be the wildest toward the end. But that gets back to the question, of Cinderella of the ball. I mean, you're there, you're having a wonderful time, the punch bowl is flowing, and the dance partners are getting prettier all the time, and at midnight it's going to turn to pumpkins and mice. And you look around the room and you think just one more dance, one more good-looking guy, one more glass of champagne, and you think you're going to get out of there at midnight. And of course everybody else thinks they're going to get out of there at midnight too. And in the end, it does turn to pumpkins and mice. And in this game, as I've said, Adam Smith said it many years ago. A fellow named Jerry Goodman wrote under the pseudonym of Adam Smith. Says the problem with that particular dance for Cinderella is that there are no clocks on the wall. And in the markets, if you're talking copper now, if you're talking internet stocks in 1999, if you're talking uranium stocks in the 1950s, there are no clocks on the wall. And the party does get to be more fun, minute after minute, hour after hour, and then it does turn to pumpkins and mice.
If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.